Now let's discuss market risk and how it's measured using something called beta. Again, market risk is the portion of an asset's total risk that cannot be eliminated through diversification. It arises from several factors like economic downturns, political events, global market changes that affect all stocks to some degree. This formula measures the amount of risk an asset brings to a portfolio. So W represents the percentage of that portfolio that's invested in stock I. The standard deviation, subscript M here, that's the standard deviation of the stock market. And correlation is the correlation between stock I and the stock market. And of course, standard deviation, subscript I, is the standard deviation of that individual stock. So this formula measures the contribution of stock I to the standard deviation of a well-diversified portfolio. So beta measures how sensitive an individual stock is to movements in the overall market. The market beta is set at 1. Stocks with a beta greater than 1 are more volatile than the market, while stocks with a beta less than 1 are less volatile. For example, high beta stocks like NVIDIA, which has a beta of 1.6, tends to rise more during market upswings, but also falls more during downturns. Low beta stocks like Johnson & Johnson with a beta around 0.7 is less sensitive to market movements, making it a popular choice for risk-averse investors. So why is beta important? It helps investors understand how much risk a stock adds to a diversified portfolio. A stock with a beta of 1.5 is expected to increase portfolio risk more than a stock with a beta of 0.8. So later, we'll see how beta is used in the capital asset pricing model to calculate the required return for a stock based on its risk. And again, as you see here, the beta of a stock is measured as, here's the correlation, that's rho, correlation times the standard deviation of the stock. That is divided in by the standard deviation of the stock market. That measures beta. The contribution of the stock to the standard deviation of the well-diversified portfolio, you take the weight times the standard deviation of the stock market, multiply it by beta. Again, this measures the beta and its impact on stock I on a particular stock portfolio. Let's talk about required return. We want to get paid. We get paid for time and for assuming risks. The risk-free rate is the pay for time. It's the base compensation. As a proxy, we're going to use the yields on United States Treasury securities, usually 20 or 30-year bonds. But the risk-free rate, we talked previously in videos, that this is an economic determined variable that's determined by the supply and demand of money, influenced also by inflation. Now, the risk premium is the extra return above that risk-free rate that investors require them to assume the risks of that particular investment. So RP here is what we refer to as the risk premium for stock I. So when you get the rate of return on investment is the risk-free rate plus whatever the risk premium is on that stock. So the risk premium, sometimes referred to as the market risk premium, is just the extra rate of return above the risk-free rate that you get for investing in the average stock in the stock market. So the risk premium of the stock market is the return in the market minus the risk-free rate. Now, the capital asset pricing model defines the risk premium as, for stock I, for instance, as the market risk premium multiplied by the beta. So the risk premium is what we get paid above time for investing in risky things. And the risk return on the stock premium, that's the return on the market less the risk-free rate. And each asset has its own risk premium. That is the market premium multiplied by the asset beta. So we have a formula that we can use. It's called the security market line formula. It illustrates the returns that we've been talking about. The rate of return in the stock is the risk-free rate plus the risk premium for that particular stock. So the security market line helps us to assess whether a stock is overvalued or undervalued. For example, if Tesla's expected return is 15%, but the security market line says it should only be 11.5%, we might be thinking that Tesla might be undervalued, right? The theory says it's only going to give you 11, but it's giving you 15. That must mean it has a much lower price. That is an opportunity to buy. And likewise, the exact opposite is true. If the security market line has a return that is greater than the expected return, that could be a signal to sell. So these insights are valuable for portfolio managers assessing which stocks to hold, which ones to trade. So we can calculate this based on our security market line formula. Here we have a risk-free rate of 4%. With the market return is 5%. So if we wanted to know what is the stock market return, it's the combination of these two, right? The risk premium, right? The risk premium of the market is the stock market return minus risk-free. So in this case, we see that the market return is actually 9%. Beta for the first stock is 6.6. So the required return, this is for our company Blandy, is 7%. The beta for Garmanja is 1.3. So we would have a required return of 10.5 for that stock. So this is what we as investors should expect to receive if we were to buy this particular stock. Now, how can we calculate some of these other variables, if you will? We can run a regression with the returns of the stock plotted on the y-axis and the returns of the stock market plotted on the x-axis. And that will help us create the slope of a regression line. Now that slope equals the stock's beta coefficient. So if we look at the actual statistics here, we say down here we have the market. That is the beta. So that coefficient right here, 0.602, if you remember, we said back here on our previous slide that the beta of Blandy is 0.61. We can also calculate beta with an Excel formula. Equals slope, and then you put the y values in the first array and the x values or the stock's values in the second array. And the slope of this regression line, that number that we receive, is the stock's beta coefficient. We can also go to a variety of websites. We can go to Yahoo Finance. We can go to valueline.com. There are many different sources, Morningstar.com, Zacks.com. All of these websites publish betas for companies. What we should find is that most stocks will have betas somewhere between 0.5 and 1.5. We could find some very low risk stocks, less than 0.5, but we also could find some very high risk stocks above 2. Again, it depends on the company, the index. It depends on the overall industry that the companies are in. What happens when things happen in the economy, right? What happens if the world changes? What happens if inflation changes? Let's say inflation goes up by 3%. This first graph here represents, here's the base case, and then what happens when the risk-free rate increases because inflation went up 3%. We see that this entire line shifts upward parallel. Why is that important? Well, if you had an investment that was right here between these two lines, before inflation happened, it was an investment that you wanted to buy. But after inflation, now that is a investment that you may not want to buy. Now it is looking at it as overvalued compared to, again, this capital asset pricing model. The other indication is what happens if investors change? What happens if things get risky and as investors we start to become scared? Our risk aversion increases. Well, what happens to the base case of security market line? It doesn't shift, it rotates. So it rotates upward so that now we're going to, for those much riskier investments, we're going to want an even higher rate of return. And it seems to grow almost exponentially because these returns down here won't change that much, but these ones will change dramatically. How can we calculate the beta of a portfolio? It is the sum of the weights multiplied by the betas. If you know the beta for each one of your companies in the portfolio, you also then know how much money you've invested in each of those. So again, it is this sum product of the weights and beta. So here we have in our worksheets, we have investment. We put $1.4 million in asset A. We put $0.6 million in B. So we invested a total of $2 million. 70% of that is in A, 30% is in B. Let's represent this as Blandy and Gourmage. So that then tells us if we have betas of 0.6 and 1.3, in this case, the portfolio beta is 0.81. So what should we expect to earn on this asset if we invested in this portfolio? Again, plugging into our security market line formula, we have, again, the risk-free rate of 4% and the stock market average is 9. If beta is 0.81, we would expect to earn 8.05% if we bought this portfolio. And in fact, if you did the formula, 70% of the 7% return on Blandy, 30% of the return that's on Gourmage, that comes out to that 8.05%. So in conclusion, let's think about this security market line and what it means for investors. Let's assume you have invested in asset JJ here. JJ has a return that is above the security market line. The security market line tells you the return that you should get, but if you buy JJ, you're actually going to get a higher return. And of course, you would like to get a higher return. So any investments that you have that are above the security market line are opportunities for profit. Anything below that represents those assets that are currently overvalued. the return that you're getting is too low compared to what you should be getting for investing in this asset. Again, capital asset pricing model and beta are far more involved than what we've been talking about in this class. But as corporate finance is concerned, I think we have understand the gist of what the security market line and what beta do for us as investments. Look forward to you in the next video.